Yo, what's up? It's Darek Invests. Let me hit you with something that financial advisors whisper about, but almost nobody explains clearly. There is a single birthday, one quiet, boring, invisible birthday that can cost a married couple $350,000 without them realizing anything went wrong. Not a stock crash, not a recession, not a bad investment, just turning 63 without planning at 61. And if you're 55, 58, 60, or even 45 and think that's far away, this is exactly when you need to understand it. Because retirement isn't just about how much money you save, it's about when you move it. And if you're new here, this channel is Darek Invests. We don't just talk about money, we talk about how the system quietly drains it if you don't know the rules. Everyone knows the big retirement numbers. 59.5, freedom from the 10% penalty on retirement accounts. 65, Medicare. 67, full Social Security. These numbers are tattooed into people's brains. But 61? Nobody celebrates 61. You don't get a discount at Denny's. You don't get a gold watch. You just get older. But behind the scenes, the government clock is ticking. And at 63, something activates that most people don't even know exists. It's called IRMAA. And no, that's not your Italian aunt. Think of your financial life like a giant building full of rooms. In your 40s and 50s, most of the doors are open. You can convert IRA money to Roth, harvest capital gains, control your taxable income, qualify for healthcare subsidies, shift money between tax buckets. You have flexibility. But as you age, doors start slamming shut. And age 61 is the last moment before a massive steel door begins to close. At 63, Medicare starts watching your tax returns, not when you enroll at 65, 2 years before. Let that sink in. And by the way, if you're realizing no one has ever explained this to you clearly, that's exactly why this channel exists. Hit subscribe to Darek Invests because most retirement mistakes aren't traumatic. They're silent, and we break down the silent ones. All right, let's keep going. Here's how IRMAA works in real life. When you enroll in Medicare at 65, the government doesn't look at your income at 65. They look at your tax return from age 63. If that year shows high income, maybe because you did a big Roth conversion, you sold a rental property, you cashed out investments, you had a one-time business sale, boom, you get hit with a surcharge on Medicare Part B and Part D. Not a small one, hundreds of dollars per month per person, and it can last the entire year. I worked with a couple, let's call them Tom and Lisa. At 63, they converted $200,000 from a traditional IRA to a Roth. Great move long term, but they did it at the wrong time. At 65, their Medicare premiums jumped by over $4,000 for the year. They weren't broke, but they were shocked because nobody warned them. Age 61 is outside the 2-year IRMAA look-back window, meaning Medicare isn't watching yet. And this gives you power, massive power. Let's break it down in simple terms. 1. Aggressive Roth conversions. At 61 and 62, you can move large chunks from a traditional IRA into a Roth IRA. Yes, you pay taxes now, but no IRMAA penalty, no future RMD pressure, no tax on future growth, no forced withdrawals at 73. You're paying taxes on your terms, not the government schedule. That's power. 2. Capital gains harvesting. If you retire early and your income drops, you might qualify for 0% federal long-term capital gains tax. 0. That means you can sell appreciated stocks and reset your cost basis legally, tax-free. Most people don't do this because they don't know it exists. 3. Strategic income positioning. If you retire before 65 and use Affordable Care Act coverage, your income level determines your health insurance subsidies. Thousands of dollars per year can hinge on how you structure withdrawals. One couple I know saved nearly $18,000 over 2 years simply by pulling from Roth instead of traditional accounts. Same net income, different tax bucket, different result. 4. Strategic income positioning. Think of your accounts like 3 buckets: traditional, tax-free, taxable. At 61, you still control the flow. After 63, Medicare starts reacting to that flow. After 73, required minimum distributions start forcing the flow. the window narrows. If you don't reduce traditional balances before 73, required minimum distributions kick in. And they don't ask politely. They force withdrawals based on IRS tables. Imagine this. You have $1.5 million in traditional accounts at 73. You might be forced to withdraw $55,000 to $70,000 that year, whether you need it or not. That counts as income, which raises your tax bracket, increases Social Security taxation, triggers IRMAA surcharges. It's a domino effect. And it all traces back to whether you used your early 60s wisely. Let's compare two identical couples. Same savings, same lifestyle, same returns. Couple A optimizes at 61 and 62. Roth conversions done early, traditional balance reduced, RMD pressure softened, IRMAA avoided. Couple B waits until 63. They trigger IRMAA. They carry larger traditional balances. They face heavier RMDs later. By age 90, the difference in after-tax wealth is roughly $350,000, not from stock picking, from timing. That's the age 61 trap. It doesn't trend on TikTok, but it is the last open exit before you enter a toll road system designed around thresholds and look-back windows. Retirement isn't just about reaching a number. It's about crossing invisible lines intelligently. You can either let RMDs dictate your income, Medicare dictate your premiums, and tax brackets dictate your withdrawals, or you can walk through the door while it's still open. And here's the truth most people don't say out loud. Financial freedom isn't about having more money than everyone else. It's about having more control than the system expects you to have. And that control is often decided years before retirement, not at retirement. If this video saved you from a $350,000 mistake, or even opened your eyes to something you'd never heard before, do one thing right now. Subscribe to Darek Invests. Because most wealth destruction isn't loud. It's silent. It's technical. It's buried in footnotes. It's hidden in look-back windows. And we're here to drag it into the light. Hit subscribe, and I'll see you in the next one.